In a massive 1.1 million square foot warehouse in Fort Worth, Texas, millions of dollars worth of goods are being stockpiled in response to the newly imposed tariffs on imports from China, Mexico, and Canada. With the U.S. economy heavily reliant on imports, particularly from Southeast Asia and China, the cost of goods is now rising significantly due to these trade policies. To mitigate these additional expenses, many companies have adopted a strategy called front-loading. This involves purchasing and storing goods in advance to bypass impending tariffs. Major corporations like Walmart and Columbia Sportswear have aggressively increased their imports from China. Between 2023 and 2024, Walmart's imports surged by 33%, while Columbia Sportswear saw a 50% increase, with a staggering 80% rise during the peak period from March to December. However, not all businesses can execute this strategy effectively. Large companies with extensive supply chains can absorb and adjust to price fluctuations, but small and mid-sized enterprises lack the financial capacity and storage infrastructure to stockpile goods ahead of tariff hikes. This unpredictability creates significant logistical challenges, making it difficult for businesses to plan efficiently.
So currently, for example, a case of avocados, we're paying about 30 to 35 bucks. Now it's going to be upwards of $80. Limes, we're paying around $20. Vendors informed us it's going to go upwards of $60.
The recent trade policies include a 25% tariff on imports from Mexico and Canada, effective February 1st, and a 10% tariff on Chinese goods. A tariff is essentially a government-imposed tax on imported goods and services, intended to encourage domestic production by making foreign products more expensive. However, the economic consequences extend beyond just businesses. Consumers will bear the brunt of these rising costs. Everyday products, such as automobiles, electronics, household appliances, clothing, and even groceries will see price hikes. For example, automobile manufacturing heavily depends on parts imported from Mexico, while China supplies essential components for consumer electronics like smartphones and laptops. Tariffs on these items mean manufacturers will pass increased costs down to consumers. Major logistics hubs, such as those in Texas near the U.S.-Mexico border, are at the center of these supply chain shifts. Large-scale shippers and distributors have responded by increasing storage space and accelerating shipments to circumvent additional costs. Some industries, particularly those related to infrastructure and technology, have seen an even sharper increase in imports before the tariff deadlines. For example, imports of lithium batteries, AI server racks, and solar panels surged in late 2024. These products are critical for data centers and renewable energy projects, both of which are major sectors of economic growth. The warehouse shelves in Fort Worth are stacked with not just consumer goods, but also industrial components that will be used in upcoming infrastructure developments. Large corporations have vast distribution networks and diversified supply chains, allowing them to absorb cost fluctuations more effectively. They can afford to negotiate bulk discounts, charter private shipping vessels, and maintain expansive storage facilities. Meanwhile, small businesses, like family-owned footwear companies, face significant hurdles. Take the footwear industry, for instance. The U.S. already imposes over 430 different tariff classifications on imported shoes, many of which date back to the 1930s. A standard men's leather shoe, for example, is subject to an 8.5% pre-existing duty with an additional 7.5% tariff under the new policies, totaling 16%. Smaller brands, which lack the leverage of global giants like Walmart, are forced to either absorb these costs or pass them on to consumers, making their products less competitive in the market. The impact of these tariffs extends beyond the U.S. economy. Mexico and Canada are key trading partners, and imposing high tariffs on their goods may lead to retaliatory measures. In response to the United States imposing a 10% tariff on Chinese imports, China has firmly opposed the move, labeling it as a wrongful and unilateral action. Beijing has announced plans to file a complaint with the World Trade Organization, WTO, and has vowed to implement necessary countermeasures to protect its rights and interests. On the other hand, Canada has announced retaliatory tariffs of 25% on U.S. goods valued at $155 billion, targeting a range of consumer products.
I am announcing Canada will be responding to the U.S. trade action with 25% tariffs against $155 billion worth of American goods. This will include immediate tariffs on $30 billion worth of goods as of Tuesday, followed by further tariffs on $125 billion worth of American products in 21 days' time to allow Canadian companies and supply chains to seek to find alternatives.
Prime Minister Justin Trudeau criticized the U.S. tariffs as harmful, potentially affecting American jobs and raising consumer prices. Similarly, Mexican President Claudia Sheinbaum has ordered retaliatory tariffs against the U.S., though specific targets have not been detailed.
Y tenemos plan A, plan B, plan C, para lo que decida el gobierno de los Estados Unidos. Ahora es muy importante que sepa el pueblo de México que siempre vamos a defender la dignidad de nuestro pueblo.
Canada is a top supplier of crude oil, minerals for EV batteries, and essential chemicals like chlorine used for water purification. Disrupting trade with Canada could drive up costs in these critical sectors, further complicating inflationary pressures. Furthermore, China has previously restricted exports of rare earth elements, which are crucial for everything from smartphones to advanced weapon systems. A trade war escalation could see China limiting access to these vital resources, putting industries that rely on high-tech components at risk. Economists predict that these tariffs will contribute to inflationary pressures by making everyday goods more expensive. The additional costs of shipping, storage, and logistics will ultimately be passed down to consumers. Even if tariffs encourage domestic production, the U.S. lacks the infrastructure and workforce to replace many of these imported goods overnight. Take shoe manufacturing as an example. The specialized machinery required for production is no longer made in the U.S., and the labor-intensive nature of the industry makes it difficult to shift production domestically without significant government investment. While industries like semiconductor manufacturing have received billions in federal subsidies, sectors like footwear and apparel manufacturing have not seen the same level of support. The new tariffs have created winners and losers in the global economy. At the heart of the issue is a balancing act, protecting domestic industries while avoiding economic repercussions. As trade policies continue to evolve, businesses and consumers alike will need to adapt to a rapidly changing global market.